The Reserve Bank Governor, Lesetja Kganyago, has made it clear that the central bank will continue using rate hikes because it's an important tool to contain inflation. Tomorrow, we're expecting the South African Reserve Bank's Monetary Policy Committee to announce its decision on interest rates. Let's unpack this now and what we might expect from the governor, and we speak to portfolio manager at Futuregrowth Assets Management, Rhandzo Mukansi. Mr. Mukansi, thank you very much for your time. The interest rate hiking cycle, some believe that it's nearing its peak, and so my question to you is 50 basis points, 25 basis points, which are you going with tomorrow?
Hi, Tony, and thanks for having me on the line. As you say, I think we're near the peak of the domestic rate hiking cycle. I think it's ultimately a tight call as to whether we'll have a 25 basis points or 50 basis points hike tomorrow. Our inclination is on the lower side of that. So our inclination is that will be hiked to 25 basis points tomorrow, but it is a tight call given how close we are to the rate hiking cycle domestically.
Yeah, why that inclination of a 25 basis points?
The central bank hiked a lot since the 3.5% low post-COVID. They've hiked cumulatively by 350 basis points or 3.5%. And if you look at it from a real rate perspective, so if you take away the inflation impact from the central bank rates, then we're at a flat real rate. If you compare that to the rest of the world, on a real rate perspective, then South Africa is ahead of the global rate hiking cycle from that perspective. So in our assessment, the central bank have hiked a lot to combat inflation, the effects of which have started to show and which we expect to continue to show throughout this year.
So from tomorrow, whichever way this goes, do you foresee another hike perhaps around March, or should we now see a decline?
I think this should be the last of it, Tony. On the basis of the current macroeconomic information ahead of us, our sense is that this is the last rate hike. It will be market dependent. I think as the Reserve Bank Governor has articulated in recent Monetary Policy Committee statements as well, is we're in a highly data-dependent world as far as monetary policy is concerned and their decision-making. So the risk is that in March we get a further hike, but our sense is that all else equal, this should be the last central bank hike in the cycle.
Yeah. The people who make this decision, we know that sometimes there's a split and there isn't really unanimity. What does that signify when the decision makers are split on the issue?
Yeah, I think that's a good question. It signifies a difference of opinion, I guess, in monetary policy committee members and their sense for the extent to which we should be hiking. They were unanimous in the 5 voting members that we should hike in November when we got the last hike, but that split does indicate difference of opinion to the extent to which we should continually hike to rein in inflation. And I think it does speak to our point and us being near the peak of the cycle, is that difference of opinion on whether we should hike by more or slightly less. So I think that really is what that speaks to. It's a difference of opinion on the extent to which we should further hike to rein in inflation in the economy, which is the central bank's primary mandate.
There are those who obviously see the interest rates hiking cycle as quite painful, particularly for the poor, who simply cannot afford it. Where I'm going with the question is, are there other ways to contain inflation? I mean, you've heard the governing party talking at length, as they have been over many years, that the mandate of the Reserve Bank cannot simply be to target inflation or inflation targeting, as the term goes. Are there other ways to try and contain inflation?
I would argue not in the central bank's current set of tools. Their primary tool is the management of monetary policy to contain inflation, and that's really the primary tool within which they affect the economy. As you mentioned, there has been talk of extending their mandates, but I think as the governor has well articulated in recent times and further out than more recent, is that the tool set is largely limited to monetary policy and the control of the repo rate. And with that being the case, then we see limited scope for the extension of the mandates, given the current tool sets that the central bank have at their disposal.
It's a tough one, because if indeed the rates are going to go up tomorrow, already I think we have seen a consecutive 350 basis points.
Yes.
This has been one after the other. I cannot imagine what that has been like for people like me who have a house to pay. It's tough, isn't it? Just how painful is it going to be for people who are paying bonds?
Yeah, no, I think I'm in the same boat. It is painful. We certainly do feel the effect of these hikes. But I think as the central bank articulates, hiking monetary policy best helps the man on the streets who cannot combat inflation, perhaps, as well as myself and you who have formal jobs, have formal employment, and expect the salary at the end of the month. For the person who does not have a job, does not expect the salary, then inflation is more impactful on that person's life than it is on yours and mine and the general working class in this economy. So it is certainly painful. We feel it in terms of bond payments and otherwise, but with an ultimate intention to combat inflation and rein in price increases over the medium term. I think that's with the lens within which we should be looking at this, and that's the ultimate effect that the central bank hopes to impact on this economy by hiking rates.
Yeah.
I'd also perhaps say that inflation is not an isolated occurrence domestically. We know post-COVID it was largely driven by the breakdown of supply chains, which the central bank have very little control over, very supply-side driven impact, and then secondary, of course, was the ongoing war in Russia and Ukraine as well, which has also had a significant inflationary impact on food and energy prices. So both of those occurrences are outside of the central bank's direct control. And their intention is quite clearly to rein in those influences on the economy and on the man of the street who has little scope to withstand higher inflation.
Yeah. Perhaps as a final question, now that I've got you, let's talk about the Global Risks Report. I think what stood out about that report, this is the report that's released at the behest of the World Economic Forum, and they've highlighted that perhaps the biggest risk around the world is potential instability because of this runaway inflation, which then sees prices of bread, fuel going up in a way that people simply cannot afford. Do you think that if indeed we do see that potential unrest, this could drive down the interest rates, or is that going to work in the opposite direction?
Maybe as a second-order effect, Colin. I think the immediate risk is, as we've seen in recent times, it's disruption of supply chains, the inability to get food from production lines to consumers, I think would be the immediate effect we'd see from this cost of living crisis that the World Economic Forum and others have spoken about. And I think the immediate effect would be continued strain on monetary policy rates given the need to combat inflation. I think in the immediate effect, I think secondary to that would be perhaps some level of growth slowdown and leveling off of interest rates thereafter, Tony. But I think the immediate risk is tighter and higher for longer, although marginally so.
Sure. Rhandzo Mukansi, thank you very much for your analysis of this situation. He is Portfolio Manager at Futuregrowth Assets. All right, still to come.